Hello and welcome to another episode of Darwin Investors. So I've had the last couple days off of work, and generally speaking, I just don't have a ton of time to sit around and think about the stock market or ways that I'm going to optimize my portfolio, what have you. But I've had the last couple days off. My wife's out of town, and so I have had a lot of time to sit around and think about this. And I've watched TV, and if you believe the people that are on television, you'd have to believe that the market's actually going to collapse probably in the next 6 months. And now I have a lot of money in the stock market, and if I believed everybody that I saw on television, I'd have to ask myself, why do I have money in the market at all? Couldn't I just like swing trade in and out of stocks for the next little while, maybe do some conservative options plays and build up a little bit more cash and then come back in, say in May or June when they believe this thing could possibly start to turn around? But the reason why I don't do that is I'm just not as bearish on the market as a lot of these analysts are. And I'm not just basing this on some sort of like warm and fuzzy feeling that I might have about the market, but I'm basing it on math and logic. I mean, statistically speaking, this market really should turn around. And I'm going to give you 7 reasons why I believe this market's going to turn around in 2023. Now, I do believe it's going to trade sideways till say about March or so, something like that. But then it'll start going up. And I think it could finish out the year up about 6 to 10% or so, or something like that. And this video could age pretty poorly, but I don't think it's going to. I think I'm going to prove out to be right. So let's get into my 7 reasons why I believe this market could go up in 2023. Now, what I've got here is the S&P 500 historical annual returns, and it's given us all the annual returns since 1928 to 2022. Now, during this time, the S&P 500 was negative 30 years, and it was positive 64 years. And what that means is over those 92 years, the S&P 500 is positive 68% of the time, and it's negative 32% of the time. Now, of the 30 negative years, the year following in that year was negative 8 times, or 26%. So let me go ahead and show you what I mean by this. So over here, since 1928, all the way till today, there's 30 red lines and 64 green ones. Now, the number of times that it was red, the year after it was red was 8 times. So meaning that it was red the year after this one, this one, this one, this one, and this one, this one, this one, and this one. Now, this chart would show from here with 68% of the time it was green, 32% of the time it was red. But more realistically, we're going to probably extrapolate out probably 1950 to the more modern day. I mean, this is kind of like an outlier, like 9 of the first 14 years or so were red, and that's just kind of not the way things are working right now. We're not going through the Great Depression and World War II. So let's kind of like look at it more from 1950 on. So since 1950, the S&P 500 has had 53 positive years and 19 negative years. And so that's why you might hear a lot of people say that the S&P 500 is positive about 70% of the time. And in this case, it was 73% positive and 27% negative. Now, when we go back into that chart there, we can see since then, every time there was a negative year, the year that it was negative after, there's 1, 2, 3 times. So of the 19 negative years, the following year was negative 3 times, or 16%. And so what this all tells me is that one year has no correlation to the next year, because this is pretty statistically insignificant. Is 16% versus 26% versus 27% of the years that it was red following a year, meaning that it's sort of like if you take a coin and you flip it, give it heads or tails, and it shows up heads, say 10 times in a row. What are the odds that that coin is going to come up heads that 11th time? It's still 50-50. And that's kind of the way the stock market is, it looks to me. It looks like, just look as purely statistically, that at the beginning of every year, you have a roughly 73% chance it's going to be green the next year. So every year is independent of the year before it. And for this reason, I'm making it reason number one why I'm bullish. And that's because, quite simply, the odds are in my favor. If you bet against me, you've only got a 27% chance of winning, statistically speaking. Now, the next reason why I'm bullish on the market is this. We have a weakening dollar, and that makes multinational companies, even if they do no more sales overseas, they're going to collect a lot more revenue and a lot more earnings. So if we look at this chart here in September, we were trading on the dollar index was at 114. It's currently sitting at 104. 1 year ago, it was sitting at 96. So it's still above where it was a year ago, but it's well below where it was in September. It's actually trading now where it was about in May. And coincidentally, the market's been trading sideways since May. But the dollar is weakening. And so for these multinational corporations, say like Microsoft here, Microsoft misses expectations, points to foreign exchange rates and weakened PC market. The company reported $51.9 billion in sales in the fourth quarter. Microsoft cited that foreign exchange rate movement negatively impacted revenue by $595 million. Now we could do back of the napkin math. We see 595 million, 51.9 billion. So it's a little bit more than 10%. Let's call it 12% of their revenue was basically taken away from them because of foreign exchange. They're likely to get a lot of that back coming up here. And it's not just them, it's other multinationals such as Facebook here. Facebook revenue during the third quarter of 2022 was $27.71 billion. Had foreign exchange rates remained constant with the third quarter of 2021, revenue would have been $1.79 billion higher. That's roughly maybe 15% right there. So 12% for Microsoft, 15% for Meta. You get the point. This goes on and on. Amazon's going to say the same thing. Google's going to say the same thing. They're all going to say the same thing. Apple's going to say the same thing. But they had an additional boogeyman. They had COVID lockdowns in China, and those are getting lifted. So Apple's got the foreign exchange problem and they've got the COVID lockdown, but we would expect that the COVID lockdowns are going to be easing up in Shanghai or just through China in general during the coming year. And that's going to help companies like Apple. And it's also going to help companies like Nike, who just reported a couple days ago. And what they reported with their revenues were up $12.7 billion, up 4% compared to the prior year and up 10% on a currency neutral basis. So they're going to benefit from China reopening and foreign exchange advantages that they didn't have, say, about 6 months ago or so. Now, what they do in their report is Nike breaks it down into what they made, and then they have percent change excluding currency changes. That's part of what they do when they're breaking down their earnings. So when you look at North America, where we have, the dollar is the dollar, 17%, 17%, well, they're also counting Canada as well and Mexico. So it's almost exactly equivalent, but not quite. But when you look at, say Europe and the Middle East and Africa, the percent change of the 3 months ended year over year was 1%. So they made $2 billion in footwear in Europe, Middle East, and Africa versus $1.9 billion is what they made. That was a 1% change, growth there. However, if they exclude the currency changes and just let's say that the dollar was weaker, then they, instead of being up 1%, would have been up 18%. Their apparel would have been positive rather than negative. And you get the point. China was still very affected over there. It was down 15% in this year. But if you do the currency exchange, it would have only been down 11%. The opening up of China is going to help Nike. The foreign exchange is going to help them as well. And so these are reasons why I believe the market could go up. So reasons number 2 and 3 that I'm bullish on 2023 are the dollar weakening and China reopening. And that brings me to the next reason why I'm bullish on 2023. If you turn on the television and you listen to any analyst from any firm, and it doesn't matter if it's Goldman Sachs or Morgan Stanley or some hedge fund you'd never heard of, everybody is saying the same thing. They're all whistling the same exact tune. They're all saying that the market's going to be down for the first 6 months next year and then it's going to bounce back. Everybody is bearish over the next 6 months. Now, if everybody is bearish for the next 6 months, I have a hard time wrapping my head around how the market may not have already priced this in to some degree. So let's go ahead and see when the next earnings season actually begins. Earnings seasons generally kick off with the big banks. JP Morgan is going to kick off earnings season here on January 13th. They may benefit from some multinational or foreign exchange services. I believe that they do. They're a big multinational bank. Microsoft definitely is going to benefit from foreign exchange advantages that they didn't have several months ago with a weaker dollar, and they're going to report on January 24th. I would expect that Microsoft could surprise to the upside, and a lot of these analysts are going to be wrong. And on the subject of earnings, when we just look at earnings in general, they haven't even really gone negative here. So here's the S&P 500 operating earnings per share up till now. It's never gone negative. It was negative in 2020. It was negative, of course, here through 07, 08, 09, but it hasn't gone negative yet, nor do I expect it to go negative next quarter. They said it was going to be negative a couple of quarters ago. They said, hey, we're going to have really disappointing earnings. It didn't happen. They said it was going to be disappointing earnings this last quarter. It didn't happen. The next quarter starts in 2 weeks. We just heard from Nike and FedEx. It didn't happen. It didn't happen. It did happen at Micron, but it didn't happen at a lot of others. So it is going to, some people are going to always report disappointing earnings, but I don't know if it's going to happen again when they start reporting here in 2 weeks. I suspect it won't. And I suspect a lot of the big multinational tech corporations are actually going to start bouncing in the upward direction. And for that reason, I'm kind of bullish on this market. Here's another reason why I'm bullish on this market. Let's look at the S&P 500 companies by weight. All right, so Apple makes up 6.2% of the S&P 500, Microsoft 5.6%, Amazon 2.3%, Berkshire 1.7%, Alphabet 1.6% on that one, so about 3% there. That total is 6, 11, 13, 15, 17, that's like 20% of the S&P 500 is sitting right there. How do you think these companies are doing? Apple's down like 30% year to date. Microsoft's down like 30%. Amazon's down 50%. Berkshire is down, I don't know what. They're down. They got an awful lot of Apple, so they're probably down 30% as well. Alphabet's down like 40%. United Health is up. Johnson & Johnson is up, but that's about it. What I'm saying is that in a market cap weighted index, which is what the S&P 500 is, if all of the top ones are already down 30 to 50%, you tell me how the S&P 500 is supposed to crash when these big companies have already crashed, unless they crash more. The other way that could happen is that consumer staples, which haven't yet come down, start to come down. Utilities start to come down. But again, compared to Apple, Microsoft, and Amazon, Duke Energy is nothing. Where are they sitting? Now, they're probably nowhere even up here. Tesla's come down. JP Morgan's gotten hammered. I mean, Home Depot's gotten clobbered. So I just don't know how the S&P 500 is supposed to come down in a market weighted index the way that it is, being as all the ones that have all the market weight have already come down. And then when we look at earnings for next year, here at Yardini, they're saying it's going to be about $225 a share. Well, I tend to agree with that. Let's go ahead and look and see how they calculate that. So you look at the S&P 500. Right now it's trading at about, having a bad day on the market. It's trading at $37.99. I don't usually make these videos when the market's open, but we're trading at about, let's call it 3,800. And so when you look at the market and you look at how they calculate what the market is trading at, all they do is they take the current rate of the S&P 500, which in this case we said was 3,800, and they divide that by the latest price to earnings ratio, which is 17.1. And they would say that this market's trading for about $222 a share. Now, Ed Yardini here in his research company says that next year we're going to be trading at about $225 a share, or roughly he says that at the end of next year we're going to be at roughly 3,900 points. I tend to think it's going to be higher. I think it's going to be like 42, 4,300. I think it's going to be a little bit higher than what he's anticipating, because I think that earnings, though they could trade sideways, there's a good chance that based on the weakening dollar and China reopening, it could trade a little bit higher than people think it's going to trade. Albeit I do understand that the housing market's going to come down. We're going to have a lot more layoffs. But that only brings me to this next point. If we have all the layoffs and the earnings come down, this chart here says that the S&P 500 bottoms before the earnings bottom. So if you look here in 2008, here's where the bottom was. Here's where earnings bottomed out. When we look at 2020, here's where the bottom was in the market. Here's where earnings bottomed out. Here's where, and now in 2022, here's where the market bottomed out. I'm guessing earnings will bottom out somewhere over here, you know, if past is prologue. And it tends to be about 11 months ahead of time. So it may bottom out like in October or so of next year. And that's when we might expect that the price to earnings, or the earnings, might bottom out. However, we would expect that the market would already be well on its way up looking forward to the year 2024. So reason number 4 why I'm bullish is because I feel that earnings already priced in. You can't have this sort of consensus. You can't have the top market weighted companies already down 30 to 50% and not have this market priced in to some degree. And so that's reason number 4 why I'm bullish, is because I feel that this market is already priced in for a disaster I don't believe we're about to get. Now let's talk about the 5th reason why I'm bullish on this market. And that reason is going to be inflation. If we look at the inflation data that's just come out, we can look at that it used to be pretty high. It'd go about 1% month over month, and then 1.3. And then over here now, if we price in the last 5 months, let's see, it's 0 plus 1 plus 4 is 5 plus 4 is 9 plus 1 is 10. That equals 1. You extrapolate that over a year, it's just a little bit over 2%. Call it 2.5%. If this continues for the next 6 months or so, and I don't see why it won't, then our year over year inflation for next year is going to be under 3%. And let me show you why I believe it'll be under 3%. Because the way that you calculate this data is you take this line and you divide it by that line, and that gives you your current inflation rate. And so all you do is you take 298.349 and you divide that number by this number here, 278.524, and you're going to get the 7.1% that we just got. That was the read that we just got. Now you can also appreciate that this number is fairly flat through here. Remember, it's only 0 and then 0.1 and then 0.4, 0.4, 0.1 again. And then this number is pretty steep. And then come February, it gets ridiculously steep. And so what we're going to have is between February and June of next year, inflation, at least from the CPI reading, is going to come crashing down. Now, in the services sector, we're still going to have elevated wages, so that's going to keep our PCE inflation up a little bit higher than CPI. And when are we going to start getting these inflation data released to us? Well, we're going to have one print on January 12th, one on February 14th, one on March 14th. But the first one that's going to really start showing a big drop is going to be here on April 12th. That's going to be our big drop off a cliff. And then it's going to continue from April through July, because that's when this chart went up in a straight line. If this one continues sideways as it has, and there's no reason to believe it won't, then this inflation's is probably going to go below 3%. That's my prediction. So reason number 5 that I'm bullish on this market is inflation decline, because it's going to drop off a cliff. At least the CPI will. The core PCE is still going to be a little bit of elevated, just because I don't believe that wages are going to come down in a way that's going to make Jerome Powell happy. However, the CPI is going to come down year over year, and that's not something we're going to be talking about. As a matter of fact, the narrative's already switching right now from inflation, because we believe inflation has already peaked. The narrative's already switching from inflation over to recession. All right, so let's talk about reason number 6 that I believe the market's actually going to bounce back in 2023. Part of what the Fed's trying to do is bring the federal funds rate above the rate of inflation. So right now, the federal funds rate is sitting at 4.25 to 4.5. Now we can see that the rate of inflation is going to be coming down pretty quickly at the beginning of next year. And if they do one rate hike right here, they're going to meet on January 31st. They're going to announce one rate hike in all likelihood on February, say 25 basis points, and another one in March. Here in March, I believe they're done, because what's going to happen is they're going to get this rate from 4.25 to 4.5, and it's going to go up to 4.5 to 4.75, and then again 4.75 to 5, and then I think they're done. They're done in March. And so the next reason that I believe that that the market's going to turn around in 2023 is that the Fed is going to stop raising interest rates in March of 2023. So the next reason why I'm bullish on 2023 is that in March, the Fed is going to end their interest rate hikes. And that's my prediction. Once the terminal rate gets around 5%, they're going to stop hiking the rates, and that's going to make the markets happy. All right, now here's the final reason why I'm bullish on 2023. And I believe this is kind of a wild card, and it's just my hunch. But that war in Ukraine could end. And the reason why is the Russian military has been slaughtered. And I just don't know how they keep this up another year. They could, and this could drag out and out and out. But I believe that they're going to come out to some sort of negotiated peace sometime by December of next year. They're just going to have to. The Russians just can't. They just can't continue in this way. Either that, or Ukraine's just going to throw them out in the spring and summertime. But either way, this war is probably going to end next year, and that's just my feeling on this one. And so that's another reason why I'm bullish on 2023. And so what am I doing with my portfolio now going forward, now that I've had some time to think about it? Well, it's interesting because the stock market, it used to be just the one thing. It was just equities. But now you got your bond store, you got your certificates deposit, you got your money market, maybe just going to park cash, and you got equity. So you got all these choices that you have to choose from. And so a lot of professionals are moving the money to CDs and to short duration bonds. And a lot of people with big money, like let's say I had a fortune, I'd probably just move into short duration bonds. Why not take a guaranteed 4.2% on a 3-month treasury? And I know I'm going to get 4.2%, but I don't have millions of dollars, so I'm not going to do that. I also believe that the stock market, I think it's going to trade sideways between now and say March or so, but it could pop in January based on earnings. You just never know. And for these reasons, I'm just going to keep my money in the stock market, and I'm going to put it into companies that pay a nice dividend. I'm going to be more defensively postured. I can't see that I'm going to be going into some wild growth stocks and stuff like that. I'm going to make sure that I stay diversified. And I will have growth stocks, but I'm going to add them very selectively. I think that Google is a growth stock. So maybe I'll add that. Who knows? I'll probably be adding Exxon. I'm trying to find a place to stick it in there, but I can't find anything to clip in order to put it in there. I'm going to continue trading options. I'm going to continue swing trading. I might be making money right now. I don't know. I've got a trade that's in there. Maybe it's triggered. We'll see. I think that the sectors that are going to benefit next year are probably going to be the healthcare sector. The energy sector is still cheap, and the technology sector. But I'm going to distill that down to the profitable mega cap tech type stocks, the ones that are the legacy tech, the ones that pay a dividend, the ones that have a lot of free cash flow. I'm going to keep it distilled down to those. But I think that those are going to be our big sectors. The sectors I'm going to be pretty leery of, and I wouldn't put my money in, especially when I think that it's going to bounce a little bit. It's going to be in staples, which are wildly overpriced, utilities, which are wildly overpriced, and some industrials like Caterpillar and John Deere. How are they supposed to go up like crazy when the housing market's going to collapse? I just don't know. I can't square that circle. So those stocks like those really kind of scare me right now. And then I'm going to go ahead and give a couple of random thoughts just here at the end. One is that Elon Musk is an interesting figure. Like I gotta admit, I don't like if Elon Musk, if people start talking about him, then I generally will turn the channel, like many of you are probably doing it right now. And so he's a figure that I don't really give too much thought about. But what I think he's an interesting case study in leadership types. He seems to be a guy that can take a company and build it, and he can do cool things like land something on Mars or start an an EV revolution. And I'm really pleased that he's doing that. And he's a guy that I think is going to go down in history as kind of like a real important person this day and age. And the reason why he's going to go down is because he's going to kind of wean us Western nations off of some of these countries that don't exactly have the best interest in Western nations. I think that the fact that we constantly rely on a lot of these countries to provide us with our energy is very problematic, considering that they don't have our best interests in mind. And Elon Musk is playing a big role in trying to get us weaned off of that system. That being said, he's one of these guys that I think is a great. It's sort of like in New York City, how they were like, how are we going to get rid of all this horse crap on the road, right? And nobody knew what we were going to do with all this horse manure because it was just piling up on the streets of New York. However, what happened? Cars came along and suddenly the horse manure problem was solved. That's kind of the way I see what Elon Musk is doing with this world right now. He's cleaning up the horse manure. And so that's why I think he's great. However, he's great at innovating and building a new company. What he's awful at is he couldn't step into, say, Jamie Dimon's role at JP Morgan. He's not that kind of leader. He's an innovator, but he's not very steady hand. It's almost like now that Tesla is built up into something, he needs to step aside. That Cybertruck should have been the first indication that maybe his days were numbered. But like basically, if I was a Tesla shareholder, or I would just want him to step aside from CEO roles, or maybe he could go invent something else or something like that. But he's not good at managing a well-established institution, it doesn't seem. And that's my 2 cents on Elon Musk. And my next 2 cents is going to be on Bankman-Fried over there. I see him, he's going in and out of jail, and the guy just looks so unnatural in jail. I mean, he's shaking, and I just don't know that vegans belong in jail. Like vegans in jail, I don't get it. But I feel sorry for the guy, and I think that all he was kind of a degenerate gambler, and I don't think he knew what he was doing. And I'm not like a Bankman-Fried apologist, but should he really be sitting in there with murderers or whatever he's sitting in there with just because he's a terrible decision maker and a problem gambler? But man, vegans in jail, what a weird mix that is. All right, that's going to do it for today. Yeah, so if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, good luck to you in 2023 and have a great day. Bye.